America is currently in a bit of an interest rate standoff, a standoff between the Federal Reserve and Donald Trump, and it's a problem that stands to wreak havoc not only with the wider economy, but also with everyday Americans. Have a look at this chart. This is the federal funds rate, or the US interest rate, over the past few years. As we can see, interest rates were at zero. They then climbed to levels not seen in decades as America battled their painful post-COVID inflation, but recent trends have seen interest rates cooling down. Inflation did cool. Jerome Powell said enough's enough, and the federal funds rate was dropped a full percentage point over 3 separate rate cuts. But with Donald Trump now implementing trade policies that are generally inflationary, what happens next is a question many economists are now asking, and it's a question that is being understandably avoided by the president. So is America about to see another inflation wave like what crippled Americans during the 1970s? Could the next move for interest rates actually be up? Interest rates are a tricky concept to understand completely, but the main thing to understand is that they determine how expensive it is to borrow money. Whether you're a homeowner paying down a mortgage or a business looking to build a new store, or the US government itself, higher interest rates make your interest payments higher, and lower interest rates make your interest expense lower. Now, it's the Federal Reserve that sets interest rates in America, more specifically the Federal Open Market Committee, a group of 12 people led by a man named Jerome Powell. These are the people that meet every month or two to discuss whether they're going to raise, lower, or hold interest rates. Now, importantly, the Federal Reserve is independent of the US government, and their dual mandate is to keep prices in the economy stable while also keeping employment as high as possible. What this means is that if inflation is ramping up, they will raise interest rates, which puts the brakes on the economy, it cools it down. And if inflation comes down, but the economy needs to be stimulated and employment needs improving, they will lower interest rates. But it is an important thing to understand. The Federal Reserve and the US government are separate, but they're also interdependent. Now, this relationship usually sees them working together. For example, when COVID hit, the US government passed massive stimulus bills to send out stimulus checks, increase unemployment benefits, and to offer businesses support. At the same time, the Fed responded by slashing interest rates to near zero to make borrowing cheaper. It launched quantitative easing, buying the government's bonds to stabilize financial markets. This lowered borrowing costs and supported the economic recovery. So the government needed to help its citizens, and the Fed helped make government borrowing cheaper by lowering interest rates. Now, that's a great example of when the government and the Federal Reserve worked together, and everyone got what they wanted at the time. But why you're seeing the media cover recent beef between Jerome Powell and Donald Trump is because the Federal Reserve and the US government aren't as aligned anymore, and this goes back to inflation. So the Federal Reserve has a long-term target of 2% inflation annually. As we know, what happened after the government and Federal Reserve teamed up during COVID is that inflation started to soar, up to a peak of 9.1% in June of 2022. And this meant that the Federal Reserve had to step in and raise interest rates to try and restore price stability, one of their two main goals. Now, this worked, and it did knock inflation back down to 2 to 3%, and it has led to 3 interest rate cuts, reducing the interest rate from around 5.5% to 4.5%. The problem we've seen recently is that inflation hasn't continued on that downward trend back to 2%. In fact, it's started to pick back up a little. And this has led Jerome Powell to essentially say the FOMC is no longer considering further rate cuts at the current time.
We do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation.
So interest rates are staying put for the time being against people's wishes for lower rates, but that also makes sense. The one thing the Federal Reserve doesn't want to do is lower interest rates too far too soon and spur on another inflation wave, where Americans suffer and all of a sudden the Fed has to raise rates again just to get things back under control. This actually happened 3 times during the 1970s, and what it ultimately led to was inflation spiking up violently to 15%, and the Federal Reserve needing to raise interest rates to 20% just to get things back under control. That's pretty painful. So the Federal Reserve is hell-bent on ensuring America does not see a second inflation wave. But then we get to the really interesting thing that's happening today, Donald Trump's trade policies. Now, I have made videos on this already, but as we know, the one thing Donald Trump has focused on so far in his second term is import tariffs. We're seeing it with Canada, Mexico, China. We're seeing it with steel and aluminium. There's talk of reciprocal tariffs elsewhere. There's a lot going on. But one of the main problems with tariffs is that they are generally inflationary.
Everybody's forecasting some inflation effect from tariffs. It'll hit the exporters, the importers, the retailers, and to some extent the consumers.
For example, with tariffs in place, when Walmart orders their avocados from, say, Mexico, they'll have to pay the US government an additional tax, normally a percentage of the total order value. So if there's a 25% tariff on goods from Mexico and Walmart's total cost rise to $1.25 per avocado as opposed to $1, this means that they need to raise prices on the end buyer of the avocado, which is the American citizen. So Americans end up paying more for lots of goods that are on the shelves. Hang on, that's inflation. That's not what the Federal Reserve wants at all. So we've got this interesting situation now where, sure, the government might push for tariffs, but the Federal Reserve might also have to raise interest rates on Americans if inflation starts to rise. This is Jerome Powell talking about the tariffs just a week ago.
The path to sustainably returning inflation to our target has been bumpy, and we expect that to continue. The new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
And for those that haven't heard Jerome Powell speak before, when he says the Federal Reserve does not need to act right now, what he's effectively saying is that they're going to keep interest rates high for the moment to wait and see what happens next. And if inflation were to rise, he has previously stated that they won't hesitate to hike interest rates. But this hasn't made Trump particularly happy, and the reason for this is because moves that the Federal Reserve make to control monetary policy have real financial effects on Americans. If the Federal Reserve were to raise interest rates, everyone feels that added financial squeeze, but as we know, when everyday people feel the negative changes in their own financial position, the first thing they point the finger at is the government, which would likely reduce Donald Trump's popularity. It would make the economic consequences of his America First trade policy very real for Americans, and it probably wouldn't feel that good. So that's point number one. And then on top of that, another reason why this annoys Trump is that higher interest rates would also start to slowly increase America's interest payments. When the government's debts roll over and are refinanced, that would happen at a higher interest rate, which kind of cancels out the effect of bringing in more tax revenue through tariffs. So it's these reasons why you see Donald Trump now trying to exert pressure on the Federal Reserve to go against their mandate and in fact lower interest rates.
I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world.
That's quite different to what we were hearing from Jerome Powell. So the short of it is we're now in this very interesting scenario where the Federal Reserve and the US government aren't aligned anymore. Donald Trump wants sweeping tariffs that will raise prices on everyday Americans and stimulate inflation. And hey, at the same time, he wants interest rates to be lowered because that's popular. But the Federal Reserve is still quite worried about inflation and is A, keeping interest rates high for the time being, is also B, sitting prepared to raise interest rates if government policy does cause the inflation rate to rise. And to be honest, this is precisely why the Federal Reserve's independence from the US government is so crucial. It provides a necessary check against short-term politically motivated decisions that may be popular, but could ultimately harm Americans' long-term financial stability. Here's what Jerome Powell had to say on the matter.
In central banking, nobody wants to be working in a central bank when inflation is really high. But everybody who works in a central bank knows what they have to do when inflation is high. But when you have very high inflation and you have to do this, this is why we're independent. It's not for the good times. It's for the times when we're doing something which may be unpopular. That is our assignment.
It's a tricky assignment because eventually you unfairly become the enemy. So I hope that makes sense as to why at the current time there's a bit of a standoff happening between the Federal Reserve and Donald Trump as each want to go down different paths. But what happens next? What are the potential outcomes we could see from here? Well, I think there's really 3 points to talk about: the economic risks of this standoff, Trump's potential response and political ramifications, and finally, what the global implications might be. So when it comes to the economic risks, we've kind of touched on this already. If the Federal Reserve holds firm and keeps interest rates as they are, That's probably the right thing to do, but of course borrowing will remain expensive. That means higher mortgage rates, more expensive credit cards, and tougher conditions for businesses trying to expand. In terms of the stock market, which had been pricing in lower rates, usually the market will struggle under the weight of prolonged tightening, although honestly, who the hell knows in this current environment? But perhaps most importantly in this argument, the US government itself will have to start refinancing little chunks of debt coming due at these elevated interest rates, which is piling on even more costs at a time where deficits are already ballooning. So that's how it's looking at the current time. Now let's say inflation actually does pick up because of these tariffs. Now, if that happens, the Fed might have no choice but to raise rates again. And this is where things get even more concerning, because if history is any guide, another round of rate hikes could very well tip the US economy into recession. We've seen this happen before. As I was talking about with Paul Volcker raising interest rates to 20% in the 1980s, it was a painful time, albeit necessary. Businesses pulled back, unemployment rose, and borrowing ground to a halt. The only way to deal with that inflation was to go big and crush it once and for all, which really, really sucked for Americans. So the question becomes, is that where we're heading again? Because make no mistake, if the Federal Reserve has to do a series of rate hikes once more, there will be consequences. Companies will slow hiring or even start laying off workers. Small businesses already struggling under high interest payments may start closing their doors. And consumers who have already been relying on credit cards and loans to get by in a high cost environment would get squeezed even harder. This is why Jerome Powell and the Fed are so hesitant. They know how fragile this situation could become. They know that one wrong move now could really hurt the US economy. So that's the economic side of the equation. Then we also have Trump's potential response and the political ramifications. Now, if there's one thing we know about Donald Trump, it's that he is not afraid to go after the Federal Reserve. In 2018, when the Fed raised rates, Trump did go on the offensive, calling them his biggest threat, saying they were crazy and out of control. Not really, they just raised interest rates. So there is the question that if Powell refuses to cut rates, will Trump escalate his attacks? Will he call for Powell's removal? Will he pressure Congress to find ways to limit the Fed's independence? I mean, who knows? Certainly this time the stakes are even higher for Trump, because if inflation does rise and the Fed is forced to react with more rate hikes, then Trump will not only have to defend his tariff policies, but will also have to find a way to explain why Americans are now facing even higher borrowing costs. And that could be politically devastating. Voters have short memories. They care about what's happening to their wallets right now. And if interest rates start climbing again, they won't blame Powell or economic theory, they'll blame the man in the White House. And that's exactly why Trump is pushing so hard for rate cuts. Lower rates would be a short-term boost to the economy, making people feel wealthier, which is good for his popularity. But of course, as we've seen before, short-term political wins don't always lead to long-term economic stability. So the real question is, who blinks first? Will the Federal Reserve cave to political pressure and cut rates prematurely? Or will Trump end up having to soften his trade stance to avoid an inflationary spiral? And then finally, beyond US borders, this situation also has global ramifications. If the US economy slows down, global markets will feel it. China has already retaliated against Trump's tariffs, and other nations are adjusting their trade policies in response. If this continues, companies that rely on imports will have to absorb higher costs, pass them on to consumers, or find alternative suppliers, each of which could contribute to price volatility and supply chain disruptions. Then, on top of that, if the Fed raises rates again, the US dollar will strengthen, which might sound like a good thing, but in reality, it makes American exports more expensive. And it's true, this could deepen the trade deficit that Trump has vowed to fix, although reduced imports from tariffs might partially offset that effect, leaving the long-term impact uncertain. So overall, that's the standoff we're currently seeing in the US. Trump on one side wanting to implement inflationary tariffs and force the Federal Reserve to lower interest rates, and then the independent Federal Reserve on the other side watching inflation like a hawk, keeping interest rates elevated and sitting ready to do the unpopular thing. So let me know what you think happens next down in the comments section below. As always, I hope you guys enjoyed the video. If you did, please leave a like on it and subscribe if you haven't done so already. But guys, with that said, thanks very much for watching, and I'll see you all in the next video.